Okay, hi everyone. This is going to be the video for the problems for chapter 1. So you can follow along, do them in Excel if you want. You could handwrite them, you could just watch it. This is really meant to show how what we learned in the PowerPoint, if we're going to give it some numbers and try to unpack the items here to better understand what's going on. So in this first example, right, they're looking at a hospital here. And then they're saying they want to know whether, given a certain type of cost and a certain cost object, whether a cost is a direct cost or an indirect cost. So if you recall from the PowerPoint, we said that there's like 5 purposes of cost classification. We use it for assigning cost objects, for the costs of manufacturing, for preparing financial statements, for predicting cost behavior, and then for decision making. In this case, right, what we're doing and what we're looking at here is assigning costs to cost objects. And we said that in that framework, depending on the type of cost object, a cost is either a direct cost or an indirect cost. So basically we have a cost, we have a cost object, and then it's either direct or it's indirect, right? So let's give this some room here. First one, right here we have the wages of a pediatric nurse. So wages of a pediatric nurse when the cost object is the pediatric department. Now, in this case, right, it's going to be a direct cost that's directly traceable to the pediatric department. That nurse's salary, she's just working for the pediatric department. It's very clearly related to that department. 2 here, it says we have prescription drugs with regard to the cost object of a patient. This is also going to be a direct cost, right? If we have a particular patient, we can directly trace to that patient the prescription drugs they use that are going to be a cost. So that's directly traceable. Third one here, let me just put some numbers here to... The third one is heating the hospital. So we say utilities for hospital. And in this case, it's going to be the pediatric department again as a cost object. This one's going to be an indirect cost, right? Those utilities, the heat, that is heating the entire hospital, one area or department of which is the pediatric department. So yes, it's associated with the pediatric department, but it's not directly traceable to the pediatric department. It's indirectly traceable to it. 4 here, we have the salary of the head of pediatrics. Salary of head of pediatrics when we're looking at the pediatrics department. Now, this is going to be a direct cost, right? It's directly related. We're looking at the department and a person who works in the department. Let's compare this here with 5 when we have the salary of the head of the pediatric department to the cost object of a particular patient. In that case, right, it's going to be an indirect cost. In other words, that department head, they serve a variety of different patients that come in. It's not just that single patient. It's indirectly traced. So this is kind of like in the PowerPoint, whenever we saw the example of a plant manager's salary, it was a direct cost with regard to the plant department. However, with regard to a particular product, it was an indirect cost. So again, same cost, different cost object, different outcome. So it all depends on what is the cost object. 6 here, we have a hospital chaplain salary with regard to a particular patient. So we have the chaplain salary with a patient. This one's going to be an indirect cost, right? Again, this chaplain, they're serving a variety of different patients. Yes, they may see this patient, but they also see others. The cost of their salary is indirectly traceable to each patient, but not a single patient directly traceable. So it's an indirect cost. 7 here, if we have lab tests and the cost object is for a particular patient, that's going to be a direct cost, right? That's like the prescription costs for the patient, right? We can directly trace this to a patient. Likewise, if we have lab tests for the pediatric department, you can also directly trace this, right? The pediatric department directly ordered all of these lab tests, right? You can see and very easily follow and see, what lab tests are responsible for, come from, or are traceable directly to the pediatric department. E12, right? What they're doing here, if we look at this, it looks like, hey, we have PC Works. It's a company, and this company, what they do is they assemble computers. So they buy different parts or components and they put them together. What they then are giving us are 8 different costs, and they want us to determine whether it's a direct material, a direct labor, manufacturing overhead, selling, or administrative costs. So the second problem here deals with the second cost classification purpose. In other words, costs of manufacturing. And we said, right, this can be broken out between manufacturing costs and non-manufacturing costs. We have our direct manufacturing costs right here, our direct materials, our direct labor. We have our indirect manufacturing costs, right, our manufacturing overhead. Then we have our non-manufacturing costs, which are like our selling and administrative expenses. So in this way, right, we have 8 different costs that we have to classify, right? So first one here, the cost of a hard drive. This is going to be a direct material. The reason being is, they're taking these components of the computers and they're putting them together to build the computer. So this is like a direct material, right? It's kind of like if you have cheese for your pizza, you use that to build the pizza, to make the pizza. This, if your company is you build computers, right? A hard drive is a direct material that goes into the computer. Second one here. Looks like they have advertising, right? Cost of advertising. Well, that's going to be a selling expense, right? If you advertise, it helps your sales. It helps people become aware of your product. 3 here. We have the wages of an employee who assembles computers. Okay, so we have wages of assembly employee, right? So they're directly there. They're putting it together, right? The computer. So this is like the guy at the pizza shop who's like, throwing the dough and mixing the dough, putting the cheese on. This is going to be our direct labor, right? They're directly working on the product. It's labor, right? We're paying salary for this person to work. So with that one, direct labor. 4 here. We have sales commissions paid to salespeople. Okay, so sales commissions. Now, this one clearly going to be a selling expense, right? It's related to selling the product. 5, we have the salary of the assembly shop supervisor. Okay, so salary of this one here is going to be manufacturing overhead. The reason being is it's kind of like an indirect labor, right? Manufacturing overhead has indirect materials, indirect labor. And in that way, right, the supervisor, he's overseeing all of it, so he's going to be indirect labor. He's not necessarily there directly working with the product, but he oversees it, so it will be part of manufacturing overhead. 6, we have the salary of a company's accountant. So we have, our accounting salary. This one going to be administrative, right? It's not really part of the manufacturing process. It's separate, external to that. 7 here, we have depreciation on equipment, so on like factory equipment or what we use in there. That's going to be part of manufacturing overhead, right? It's part of the manufacturing process. It's indirectly related, that depreciation, so it will be in there. Next here, we have rent on the industrial park. Now this one is kind of tricky. It's just going to depend, right? What you're going to do here is you're going to break out pro rata based on size, right? Like how much, if we have first off, an industrial park, it's like a big playground almost, right? It has like the building, a park, it has a variety. It's like the whole shooting match is there. Every part of the business is there. So you may have the manufacturing part of it. You may have the CEO part of it, the accounting part. What you would do in this is if you're renting that whole thing, you would have to break out based on physical space taken up, how much is related to the manufacturing portion versus the non-manufacturing portion. So that's what you would do there. There's not enough information here to do that, but that's procedurally how you would take it from there. E13, right? Let me take a drink real quick. Of water, of course, right? Got to clear my throat. A lot of talking on these videos. I teach a bunch of other classes, so I usually am a little bit parched whenever I'm speaking. So water is very helpful. In any event, right here for exercise 1.3, we're now looking at the third purpose, or the third cost classification area. We would use it to help us prepare financial statements. Specifically, we would look at product costs versus variable costs, right? Versus period costs. Too many costs, right? Too many costs. So what they're doing here is they're giving us 15 different items, right? So like 1, 2, 3, 4. Oh, the smart feature is nice, but when you have a little blip in it, it also copies over the blip. So what we're going to do here is we're going to have a cost, and then we have to say, is it a product cost or is it a period cost, right? We said when we're talking about like inventory in financial accounting, generally your product cost you're going to capitalize and put on the balance sheet. Then when you sell the item, you'll get the expense for cost of goods sold. Whereas our period costs, these are going to be expenses that you take as they happen in the period, as they incur. And a lot of this comes down to kind of an easy trick is does this happen in the plant or outside the plant? It's not always going to guarantee the right answer. There's different types of businesses, but if we're talking about the manufacturing plant, like a manufacturer, this is a good way, a good rule of thumb to start with. So 1, right, we have depreciation on salespeople's cars that they use in the business. This is going to be a period cost, right? Salespeople, that's a non-manufacturing cost, not associated with actually creating our inventory, manufacturing it. We're going to expense it in the period as it's incurred. 2, we're going to have rent on the factory, right? Well, this is going to be a product cost, right? It's a part of manufacturing overhead under our manufacturing costs. 3 here, we have lubricants used for machine maintenance. Okay, so lubricants for our machines in the plant, right? So this is going to be some of our indirect materials, right, that are part of the product, right? So that's going to be a product cost. We capitalize it. 4, looks like we have salaries of personnel who work in the finished goods warehouse. Okay, so salary of people who work in finished goods warehouse. Well, in this case, right, the product is already made. We're outside the plant. This is more of like a shipping or a packaging after the fact type thing. It's not something that we normally do when we produce it. So this is part of finished goods. It's like a selling expense. 5 here, we have soap and paper towels used by factory workers at the end of the shift. So I'm just going to put soap used by factory workers. Okay, it's going to be part of manufacturing overhead, right? It's associated with our people who work in the plant. That cost will become part of our inventory on the balance sheet. So it's a product cost. 6 here, right? We have factory supervisor salaries. Again, this happens in the plant. It's going to be a product cost in this case, right? It's going to be part of our manufacturing overhead. 7, we have utilities in the factory, used in the factory, right? Well, if it's in the factory, it's going to be a product cost, right? It's associated with producing our product. It's going to be part of manufacturing overhead. Now 8, we have materials used for boxing products for shipment overseas. Okay, so we have shipping costs in this case. And that, again, the product's already made. Now we're just looking at shipping it. That's going to be a period cost. 9 here, right? We have advertising costs. Well, it's also going to be a period cost, right? It happens outside of the plant. It's really a non-manufacturing selling expense. 10, we have workers' comp insurance for factories' employees. So workers' comp insurance for factory employee. Well, if it's in the factory, right, that's going to be part of manufacturing overhead. It's going to capitalize it, product cost. There we go. 11, right? We have depreciation, in this case, on chairs used in the factory. Now, if it's in the factory, right, it's likely a product cost. 12 here, we have the wages of a receptionist in the admin office. Okay, so we have wages of receptionists in admin office. Outside of the plant, where it happens, going to be an administrative cost, a non-manufacturing administrative costs. 13, we have the cost of leasing the corporate jet used by the company's executives. So I'm just going to put corporate jet used by CEO. Obviously, right, this is a period cost. This isn't like part of the manufacturing process, the fact that our CEO is flying around in a jet. He's not in the factory directly working with it. This is a non-manufacturing administrative cost. Expense it as we incur. 14 here. Looks like cost of renting rooms at a Florida resort for the annual sales conference. So we'll just put rent for sales conference. Selling expense, non-manufacturing selling expense outside the plant, going to be a period cost. We expense it as it incurs. And finally here we have packaging the product. This is going to be a product cost, right? It's still in the plant. It's like we just got done making it, but now we have to package it, right? It's normally packaged in that case. So in that event, right, it's going to be a product cost. So you can see here, right, we're just looking, we're doing a lot of examples with classifying, working through, giving some teeth to the material that we learned in the PowerPoint. Let's look here at E17. Okay, so they're giving us a company here, right? And they say the relevant range is 18 to 22,000 units. So when that happens, when we're in the relevant range, the following, when we sell 20,000 units, we're in it, we're in between. We're going to say our average cost per unit is as follows. So it looks like we have direct materials, direct labor. They then break out manufacturing overhead into the variable portion versus the fixed. It looks like we have some selling expenses and administrative expenses that are fixed. We have some sales commissions, and then we have some variable administrative expenses. Okay? So what they're doing here, right, they're going to have different cost objects. So looks like the first cost object is units of production. Looks like the second one, the cost object is the manufacturing department. And then the third one is the cost object is the company's various sales reps. Okay, so it's going to shift our perspective a little bit on each one. But with it, right, for 1A, they're saying, assuming our cost object is units of production, can you please tell us our total direct manufacturing costs? That's what they want to know, right? And when we sell or when we make 20,000 units, okay? So if we look at this, right, we're trying to find our total amount. They give us a per unit amount. So we're going to have to use this 20,000 at some point, but we're really looking for our direct manufacturing costs. So our direct manufacturing costs here, it's going to be our direct material per unit. It's going to be our direct labor per unit, right? So if we look over on the left, that's going to be 7 and 4. It's going to take us to, our direct manufacturing cost per unit, right? It's going to be 11. And then what we do is, right, we're going to multiply that times the 20,000 units we produce. And that's going to give us, in this case, our total amount of direct manufacturing costs. So in this case, it's going to be what? 11 times 20,000, $220,000. That would be our total direct manufacturing costs if we're looking at units of production when we have 20,000 units. 1B, they want to know, can you please tell us our total indirect manufacturing costs for 20,000 units to make it. So in this case, right, we're really looking at our indirect manufacturing costs. So that's going to be our manufacturing overhead. And in this case, right, we have variable manufacturing overhead per unit, and we have fixed manufacturing overhead per unit. It's going to be, right, from over there, $1.50 per unit, 5. So that's going to be what, $6.50, right? We sold 20,000 units. So in this case, right, our total indirect manufacturing costs, it's going to be 6.5 times 20,000, 130,000. So the idea with this is, right, they're looking at one particular cost object here, units of production. And then in light of that, they want to know our total direct manufacturing costs and our total indirect manufacturing costs. So that's like one of the things with this chapter that's kind of interesting that you'll see is they kind of teach these ideas like separately from each other, like 5 different purposes. However, when you go through it, you can see that you can really like mix and match them, describe them together, right? So like we learned about direct and indirect costs separately from manufacturing costs. However, you could ask for total direct manufacturing costs. They kind of congeal them together. So if we're looking here at 2, right, assume the cost object is the manufacturing department. And they want to know here, they want to know so we have 2A, right? They want to know how much total manufacturing cost is directly traceable to the manufacturing department. Okay, so what we have to do here is, of our total manufacturing costs, that is to say, all our manufacturing costs, we have our direct materials, our direct labor, our manufacturing overhead. How much of that are we going to directly trace to the manufacturing department? So here what we're going to do is we're looking at our total manufacturing costs. So that's our direct materials per unit. That's our direct labor per unit. It's our variable manufacturing overhead per unit. It's our fixed manufacturing overhead per unit. Right? If they're looking at total manufacturing costs, it's just manufacturing costs are materials, labor, manufacturing overhead. We're just subdividing this here. So in this case, right, it's going to be 7, 4, $1.50, 5. If we were to total that, right, it's going to be $17.50 per unit. Total manufacturing cost per unit. They want to know for 20,000 units. There we go. It's going to be $350,000. In other words, our total direct costs here are going to be $350,000. Our total manufacturing costs directly traceable to the manufacturing department. 2B. To be or not to be, right? I guess that is the question. 2B says, how much of the total manufacturing cost is an indirect cost that cannot be easily traced to the manufacturing department? So the answer here for 2B is going to be none of the manufacturing costs should be treated as indirect costs. The reason being here, the cost object is the manufacturing department. It's going to be all direct because it depends on the cost object in question. These are directly traceable to the manufacturing department. So we'll then move on to 3, right? We have 3A and 3B. 3 is a little bit tricky here, right? So we're going to read this and break it out. It says, assume the cost object is the company's sales reps, okay? Then it says, assume the company spent $50,000 of its total fixed selling expense. Okay, so we have our total fixed selling expense. $50,000 of that amount was spent on advertising, and the remainder was spent on comprised the fixed portion of the company's sales reps' compensation. So, like if this was 90 and that was 50, then the remainder, 40, would be there. But this is the setup of what they're saying. Of our total fixed selling expenses, 50 was for advertising. What was left over is for the fixed portion of our sales reps' comp. So maybe that flat salary they get, right? So they want to know here for 3A, when the company sells 20,000 units, what is the total direct selling expense that can be readily traced to individual sales reps? Okay, so for 3A, the first step in calculating the total direct selling expenses, what we have to do here is we have to determine the fixed portion of the sales rep's compensation. So first thing we got to do to resolve this is determine fixed portion of sales rep's compensation. So What's going on here, if we look at it, right, we have our fixed selling expense per unit, right from over there, that's 350. We then have, in this case, units sold of 20,000. Right, so we're going to have, in this case, total fixed selling expenses of 70,000. Okay, that's a starting point. Carry that down. Then what we'll say here is, so what's going on at this point then? It's like this is 70,000, which means that this then must be 20,000, right? So in other words, if we back out the 50,000 for advertising, we know that 20,000 in that case is going to be, right, the total fixed portion of the sales reps compensation, right? And that's kind of the first thing we need to do is, right, determined, this 20,000 right here as part of it. Then what we do, once we determine that, right, we're going to look and do a second step here. And we're going to say, in this case, for the second step, we have to calculate our total direct selling expense that's traceable to the individual sales reps. So what we're going to do here is we're going to say, right, we have our sales commission per unit. From up there it says that's $1, right? We know we sold 20,000 units. So if that's the case, they get $1 commission per unit. We sold 20,000 units. Then in that case, right, our total sales commission is going to be $20,000. Right? So if we have our total sales commission of 20,000, and then we have our fixed portion of sales rep compensation of 20,000, right? It's kind of like you have to solve for this first and then it carries down. What we then can see in that case is if we add those two together, right, we can find our total direct selling expense. And that's what it's asking for, right? They want to know what our total direct selling expense, readily traceable to sales reps. So what we're really doing here is we're saying, hey, those sales reps, right, they have kind of a fixed component to their compensation, what we determined is $20,000. And then they also have like a commission component, right? For everything they sell, they get on top of that, right? It's almost like a variable component. It's a function of how much they sell. So in this case, it was 20. So if they get 20 base plus 20 from their sales commissions, there's going to be 40 total. That's a direct selling expense, readily traced to our individual sales reps. 3B here, they're saying, what is the total indirect selling expenses that cannot be readily traced to individual sales reps? In this case, right, it's going to be, as I have here, the total indirect selling expenses that can't be traced. It's going to be $50,000, right? The advertising expenses, basically, you can't trace those to the sales reps. You know, they're separate. It's a separate item. In other words, we have our selling expenses here, and part of it is related to advertising. Part of it is related to sales reps. The advertising that's separate from the sales reps. So let's look here at E19 for the next item here. So they're saying, look at E17. I basically took the information from there. And they want us to do some things, right? We have 1, 3, 5, and 7. So we have 1. Let's start there. They say, if 18,000 units are sold, produced and sold, what is the variable cost per unit? So they want the variable cost per unit sold. Okay, so what we're really doing here is we're kind of plucking out which of these items are variable costs, right? So we have our direct materials, we have our direct labor, we have our variable manufacturing overhead, our sales commissions, our variable administrative expense, and that's going to be all of the variable costs, right? And they're basically the things that aren't fixed, right? So if it says fixed, it's fixed. If otherwise, in this case, it's going to be variable. So if we look at those, right, it's going to be $7, $4, $1.50, 50 cents, right? So we could sum all of these up. It's going to get us to $14 variable cost per unit sold. All right, that's going to be the answer for that one. If we look at 3, they want to say if 18,000s are produced and sold, what is the total amount of variable costs related to the units produced and sold? Okay, well this is pretty simple, right? All we're doing here is we're taking this information from up here and we're saying we sold, 18,000 units for 3? Yeah, 18,000, right? So what we would do is the $14 variable cost per unit times the 18,000 units. This would be our total variable cost. So in other words, this is our variable cost per unit. This is our total variable cost, 252,000. Next we have 5. Right, for 5 they say if 18,000 units are produced, what's the average fixed manufacturing cost per unit? Okay, so for 5 they want the average fixed manufacturing overhead per unit. So this one, what we would look at in this case is, what we would say is, hey, first off, what is our total fixed manufacturing overhead? And what we would do here is, we would first need to calculate that amount, right? So kind of, in the same way before we had to solve something to help us, here we have to do a similar thing. So that's what they want, but first, step 1 is, and this is going to help us for later problems, we need to figure out our total fixed manufacturing overhead, right? Our total fixed manufacturing overhead. They want average, but first thing is we need to figure out our total, right? So what we're going to do here is we're going to take our average fixed manufacturing overhead per unit, right? So that's going to be, in this case, $5, right? We're going to say we sold, in this case, 20,000 units, right? That's the number of units we produced. If you go back to 1.7, right, they're using the 20,000 units here for this relevant range where it's true. So that's going to get us, right, if we do 5 times that amount, it's 100,000 is going to be, in this case, our total fixed manufacturing overhead. Now with that, right, if we know 100,000, right, if we have our total fixed manufacturing overhead of 100,000, right? We snag it from over here. What we then do is, here we have to divide it by the 18,000 units we produced. So if we do that, right, the 100 divided by 18, we're going to get roughly $5.56. This is going to be what they're asking for, right? Our average fixed manufacturing overhead cost per unit produced. So the idea here is that's what they're asking for. Here's the answer. Here's how we got it. Step one, we have to figure our total manufacturing overhead. Here we're using 20,000, right, based on the fact, this is what's going on with it. And then what we do from there is we then take that number, divide it by the number of units actually produced to get us our fixed manufacturing overhead per unit. So it's a little bit tricky, right? One thing to be aware of, right? When you're using the $20,000 here, the 20,000 units, the average fixed manufacturing overhead of that cost per unit of $5, it's only valid for that level of activity. You're using it basically to back into the total fixed manufacturing overhead. It's basically you're just using this situation to figure out the total amount. Then when you figure out the total amount, you use what's produced here in this situation. So it's kind of like situationally figuring out the total, which is going to apply to any example, then applying the specific instance here of 18,000. 7, right? 7 says, hey, if 18,000 units are produced, what is the total amount of fixed manufacturing overhead incurred to support this level of production? Well, 7 here is going to be 100,000 still. Total fixed manufacturing overhead, it's the total amount and it's fixed. So it's going to be regardless of change there, it's going to be always 100,000. Finally here, right, we have problem 121. So they're giving us some information. Right there, it looks like we have a piano company. We have Marwick's Pianos. They purchase pianos from a large manufacturer. Average cost is $24.50. These are pretty expensive pianos. Looks like they then sell them for about $31.25 each. The company's selling and administrative costs for a typical month are presented below. Okay, so they give us some selling and administrative. 1, they want us to prepare a traditional income statement. So we'll do that first. And then 2, they want us to prepare a contribution income statement, contribution format income statement. So with our traditional income statement, remember we said it's like our sales minus our cost of goods sold, gives us our gross margin. Then we back out our selling and administrative expenses, gets us to net income or net operating income. So in this case, right, we'll start with sales. And what we're going to do here is they're saying that during the month we sold and delivered 40 pianos, right? So we have 40 pianos times $31.25 we sell the piano for. It's going to be $125,000 in sales. However, from that, we need to back out our cost of goods sold. And again, we sold 40 pianos. Remember we said you take the expense for cost of goods sold when you sell the item. And we said that it cost us, on average, from those facts, $24.50. Right, so it's going to be $98,000. Accordingly, right, if you were to take your sales minus your cost of goods sold, we're going to have $27,000 of a gross margin. From that, right, we have to back out our selling and administrative expenses, right? So you could summarize these and then total them. We'll just list them out. We can subtract them as like a big sum. So we're going to have first our selling expenses. Maybe I'll just make that italicized. So first one's going to be advertising, right? If we look over there, it says our advertising is $700 a month. Next one we're going to have is sales, salaries, and commissions, right? So if we look over here, it looks like it's $950 per month plus 8% of sales. Okay, so we're going to do equal. We're going to do, let's see here, right? It's $950 a month plus, in this case, right, it's going to be 0.08% of our sales. So in that case, it's going to be $10,950. Another selling expense here that we're going to have, right, and we're just working our way down here, is we're going to have our delivery expense, right? And with that, we sold 40 pianos. We know from the facts here that it costs us $30 per piano. So we're going to have $1,200 there. We have utilities, and then we have depreciation of sales facilities. So for utilities, fixed amount, same with depreciation. In that way, right, we're going to be able to calculate our total selling expense. Next, we have to do our administrative expenses, right? That needs an N there. So here, right, for our administrative expenses, we're going to have our executive salaries. That looks like it's going to be $2,500 a month. We're going to have our insurance, $400. We're going to have our clerical. So this is going to equal, according to the facts over there, right, it's $1,000 per month plus we have to do $20 times each piano we sold. We sold 40 pianos. So it's going to be $1,800 in that case. After clerical, we have depreciation of office equipment right outside the factory. It's going to be a period cost. In that case, right, it's going to be a flat $300. So if we were to sum all of these guys here, right, it's going to be $5,000. Our total administrative expenses, okay? So basically, if you summed both of those, right, if you have your total selling and admin expenses, it's going to equal $14,000 plus the $5,000, you're at $19,000, right? So from that, if you were to take your gross margin minus your selling and administrative expenses, you would see that you have net operating income of $8,000, right? So start with 125, end with 8. Let's now do 2 and compare it with a contribution income statement. And we said for this, really what we do is we take our sales minus our variable costs, gets us our contribution margin, minus our fixed costs, gets us our net income. So our sales, right, in this case, 1 second here. Our sales, we know from over here, are 125,000. That's same regardless. So let's just have a total amount, and then we can do per unit, right? We sold each one for what, 31.25? Yep. Okay. The next item here is we have to back out our variable expenses, right? So let's find our variable expenses. We have cost of goods sold. And the idea with this is it's going to be 40 pianos times the 2450, right? It's going to be 98,000. It's the same number as over here. So like we could calculate that and do it again. But what I'm going to do is, right, just to speed things up a little bit, I'm going to list them out and I'm just going to copy it from over here. So if you want to know how we got the number, watch it over here. So we have cost of goods sold. We have sales commissions. In this case, so the sales commissions, these are actually going to be a little bit different. The reason being is with it, right, we have to break out our variable component with it. So what we did over here is we like lumped everything together. Over here, what we did, we're breaking out like the variable component from the fixed component. So sometimes, yeah, we can just like snag the numbers from over. Other times we do need to recalculate them because we need to separate the variable portion from the fixed portion. So in this case, right, the variable portion is going to be 8% times 125,000. So in that case, right, we're going to have 10,000 of sales commissions, and let's just get rid of that column for the time being. It's a little bit of a distractor there. The next one that's a variable expense is a delivery of pianos. So again, we have 40 pianos times $30 per piano. It's going to be $1,200. And we have our clerical expense, right? That has a variable component to it. So it's going to be 40 pianos times the $20 per piano clerical expense, $800. So our total variable expenses are going to be 110,000. Then we got to break out our fixed expenses. So in this case, right, our fixed, we have our advertising, 700. We have our sales, right, the fixed amount of $950 a month. We have our utilities of $350. We have our depreciation of sales facility of $800. We have our executive salary of $2,500, insurance of $400, clerical of $1,000, and then depreciation of office equipment, that's going to be $300. Right, so it's basically all of our remaining expenses that aren't variable. So if we were to sum all of these, right, it would be 7,000, our total fixed expense. Okay, so if we have, in this case, right? What we would do, how we would break this out, let me add one more row here. Why isn't it moving down? Insert, okay, shift cells down. All right, so what we would do here first is we would take our sales minus our total variable expenses. This would get us our contribution margin, right? 15,000. Then what we do, right, from that, from our contribution margin, we would subtract our total fixed expenses to get our net operating income. So again, right, we have the same sales, same net income, really the same expenses in between. It's like we jumbled it up, but sometimes we can use the numbers, from the traditional, other times we can't. And the reason for that, as we shown there, is we have to break out the fixed component from the variable component. Some of these expenses over here, they have both of them combined in it. So we have to kind of separate them from each other. So with that, we'll end the lecture here. This is, again, just giving you some orientation for it. If you want to see how more of this and how it can be tested, I would encourage you to look at the optional multiple choice questions. Again, accounting is very different in different ways. In other words, how we learned about it in the PowerPoint is one way, right? That's introducing the concepts. How we learned about it through these problems are another way, like writing things out. A third way you can learn accounting, in an educational capacity, is just through repetition, right? And you'll learn it, more detailed through going through those optional multiple choice questions. There's 100, 200. You don't have to do all of them. But if you want to go through, look at them, get a feel for that. Sometimes for homework, even sometimes for tests, what I'll do is I'll just make a similar problem, but I'll change the name and I'll change the numbers. So if you're stuck on the homework or you're unsure of something, just go look at those optional problems. See if you can find something similar, look at the answer key, and then kind of rework the problem with different numbers. Sometimes that'll work, sometimes the questions aren't going to be in there. I do, probably 9 out of 10 questions I write myself, so you won't find those on chegg.com. So I say all of this, it's better to use those optional problems, learn from them, than it is to just try to look up the answer. But like I said, for tests and stuff, you're not going to be able to do that. First off, it will be monitoring you, so it would flag and I'd get a signal for that. But two, I write my own questions. So when you use publisher provided stuff, a lot more of that tends to be out there. But when you write your own questions and you take the time to do it, it tends to be a little bit more protected from that. So in any event, right, I just wanted to give you a rundown of this chapter. It's an introduction to managerial accounting, looking at different ways we can classify costs. Even though they're taught kind of separately, you see how we can congeal them all together. Moving forward, right, we're going to build on this. The class is interesting. We will look at different topics, different areas. In some ways it does. It's like lockstep. You do one thing and then it builds on that for another. Other chapters are going to be very different, where it's you could independently learn it. So with all of that, I'll end the lecture here. We'll see you guys in the Chapter 2 lecture, and feel free to reach out if you need anything.